Welcome to Inside India. I'm Emily Tan, sitting in for Sri Jegarajah this week. Here are your headlines. The Indian markets extending gains, the Nifty rallying past a key level to trade at its best of the year. We'll find out if that rally has legs. And reports are emerging that the National Stock Exchange of India has paid to settle a dispute with the country's regulator in order to move ahead with its stalled IPO. Gold may be off its recent highs, but the precious metal is still on pace for a monthly gain. And one of our guests coming up thinks it could even top 4,000 in the coming months. We'll discuss. A very good morning. Let's start off with a look at Asian markets. It was a very mixed at last check, and it continues to be the case. The standout here, the Nikkei 225, better for 1%, 39,349 last traded. The Kospi, though, tipped to the downside, off more than 2% at 3,040. We are mixed across the Greater China markets, with the TAIEX better on the session by 0.4%, but Hong Kong and the Shanghai Composite seeing some fractional losses. The Hang Seng Index at 24,386. The Indian markets come online in about 45 minutes, and here's what Gift Nifty futures are indicating. We're looking unchanged at the moment. A Nifty 50 set to open at 25,244. The Indian rupee at 85,905 last traded. The Nifty 50 saw its best session of this year on Wednesday, breaching key resistance of 25,200. And to one of our top stories of the day, India's National Stock Exchange actively clearing hurdles with its IPO. The exchange reportedly offered to pay the Indian markets regulator around $160 million. That's to settle a legal dispute so that the country's biggest stock exchange can move forward with a public listing. If it goes through, it will be the largest sum ever offered to the Indian regulator for a settlement. The regulator, CB, fined the NSE for failing to provide equitable access to all its trading members. The two have been negotiating an out-of-court settlement on this. Last month, we spoke to Chairman of SEBI Tuhin Kantapandi, and here's what he said on the NSE's planned listing.
I think all of the issues will be resolved. I think that much I can say, both on the governance, litigation, technology, all of it. It's possible to resolve. I think they're quite amenable to solutions.
Moving to the energy sector, both India and China are cutting their coal imports from Indonesia. This as the two countries shift to high-grade coal and competitive prices. Higher-grade coal would yield more energy per ton. Indonesia is the world's largest exporter of the commodity, but now importers are looking to countries like Tanzania and Kazakhstan for better material. And a quick check on oil. We're seeing some gains in the Asian session, but they have pared back significantly from the initial surge following the Israel-Iran conflict. Prices, though, are still 20% lower than a year ago. WTI up 0.5% to 65.22. Brent last traded like that. We've got, of course, safe haven plays in focus. We've got the Dixie at 97.41, the Japanese yen at 144.71 against the greenback, the 10-year, where we don't have a yield there, but the Swiss franc at 0.8032%. Also checking in on gold. This as a central bank has been on a gold buying spree in India. The RBI's gold vault has increased by around $16 billion since the beginning of this year, hitting the $80 billion mark. Gold reserves now making up for over 12% of the assets in India's forex reserves. The World Gold Council released a survey last week. It expects that global central banks will continue to show a strong appetite for the yellow metal going ahead, and that's mostly due to rising geopolitical uncertainties. Anindya Banerjee is the head of currency and commodities at Kotak Securities and joins us now live. A very good morning, Anindya, and thanks for joining us today. If we can begin today with just your take on where gold prices are hovering right now. Of course, the ceasefire that we got to hear about Israel and Iran as announced by President Trump, although fragile, seems to be holding. What do you make of gold trading right now?
A very good morning, and thank you for having me. Gold actually is benefiting from a structural story, and the structural story is of de-dollarization, which means if you look at simple data, which is the World Gold Council and BIS came out with a survey some time back, where they tried to estimate how much of the FX reserves of the global central banks are in dollars, in gold, in other currencies. And some startling facts actually came out, which means that gold is now the second largest holding, replacing the euro. And that is telling us that as the world moves away from a single country reserve currency, that is the US dollar, towards a much more multipolar world order, the demand from central banks are going to be there. We expect this, the current share of gold as per World Gold Council's around 20% We expect this to rise to 25 to 27% in the coming years. So that compelling underlying demand for gold will continue to be there. But along with that, we also have the speculative demand which comes from time to time, driven by either weakness of the dollar that is currently happening, or due to geopolitical tensions which happened a couple of weeks back. So the geopolitical tensions and ebbed, so that's the reason why we have seen an up move and a down move in gold, and gold is now stabilizing around $3,300. But as I said, the underlying compelling demand story for gold is intact, and that will continue to push gold higher in the coming months.
As we talk about gold as a safe haven, you've mentioned the U.S. dollar, but how does it compare with the likes of the Swiss franc, U.S. dollar treasuries, or even crypto?
If I compare gold with the crypto, the point is crypto at this point is very exciting as a class. It's getting adopted across the world, but it's at a very infancy stage. And the kind of volatility which we see, it cannot be really used as a store of value. And gold has been a store of value since time immemorial. If I look at the period just before 1971, we had the gold standard, right? And even after 1971, gold did not lose its share of the central bank reserves. So gold was still considered to be money. So that kind of an appeal will continue to be there in gold. And if I compare it with what is happening in the U.S. Treasuries. The U.S. economy is slowing down, and the whole America First policy, which will lead to higher tariffs and a fractured global trade order, is going to be inflationary for America. So we'll have a stagflation kind of environment in America. That's what we expect in the coming quarters as consumption slows down. And at the same time, as Federal Reserve Chairperson has indicated, inflation may pick up. Now, such a scenario where you have a slightly higher inflation and weak growth, and central bank is not able to support growth because of high inflation, that is where gold does well, because it creates a certain uncertainty around the U.S. financial system, around the U.S. dollar. And so overall, if I compare this entire backdrop, gold actually outshines.
If we look at cryptocurrency, you mentioned that it is still in its infancy, but as we talk about new asset classes and the eventual on-taking of CBDC, central bank digital currencies, could these displace gold as a safe haven asset?
CBDC and crypto, what I understand, are two different. One is private money. The other one is basically a programmable money of the central bank. So like we have the physical notes and coins, we have the electronic payments, And we also have now the CBDC, which is basically a programmable money, but basically it is a central bank's money or the government's money, which is in a different format. So CBDC and gold are not competitors, but gold is going to, the reason gold is being accumulated in our opinion is because as we head towards a multipolar world order by the end of this decade or early part of the next decade, you need a central anchor which will actually anchor all the global fiat currencies with it. And gold has been that. It could be gold and silver, but gold, is, in our opinion, is going to be one of the important central anchors. So CBDC could be the format in which the global, the monetary system may evolve to, but the anchor is going to be gold.
If we're tracking and looking at gold prices currently hovering around 3,300, your target is 4,000. What's going to get the prices there?
See, it's going to be a combination of things because we are looking at, let's say, a 22% jump from the current levels. We have a timeline of around 12 to 18 months. It could happen sooner. But the biggest trigger which we are looking at over the next 12 months or so is the depreciation of the US dollar. Because again, I'll come to the America First policy. Now, America First policy, where America is trying to become a producer at the current level of the exchange rate, that is very difficult. Even with higher tariffs, it needs a weaker dollar. Whether it is able to bring a policy to weaken the dollar, something like the Plaza Accord 2, but we are of the view that dollar is going to weaken as we head into this year, into the next. And also, if you look at the US economic backdrop, as I said, that the tariff policies is going to be bad for the US consumption story. So as the US consumption slows down and a stagflationary environment emerges, that will also have a negative impact on the US dollar. So the weakness in the US dollar is going to be that extra factor which will push the gold prices higher. And since over this year, gold prices have risen by around 27%. That is a phenomenal rally which has happened, right? So it is currently undergoing a time correction, which is quite healthy, and it may continue to be in that zone of let's say $3,200 and $3,500 for the next couple of months. And we expect then from October or November onwards it to start rallying upward, and by around March or April of next year, it could be closer to $4,000.
So is there any downside risk? We're looking at this 1 year up 45%. If we don't see further escalation in the Middle East, if there is a ceasefire managing to hold, could there be some downside or a little bit of a correction?
Right. Yes, the biggest risk for gold is if we have an event like what happened in April. Means if we have a situation where there is a market-wide sell-off, that risk is there with financial assets. In that situation, what happens? You tend to see a lot of margin-related selling across the markets, because it's in those circumstances, people sell not what they want to sell, but what they have to sell. So that's exactly is a biggest risk for gold. And so that's the reason why, as I said, that between now, that's end of June until October, the gold prices may actually be in a range. And if some kind of margin-related selling emerges, we could see that 3,200 come down towards 3,100, but it is unlikely that gold prices will be trading below 3,100. So any dip of that nature is an accumulation opportunity for long-term investors.
We're tracking the central banks buying gold aggressively. Do you expect this trend to continue, and which central banks are leading this?
See, the BRICS Plus countries are the ones who are actually taking the lead, and the Chinese central banks, the Indian central banks, they tend to accumulate through various ways, the official channels, the unofficial channels. So we will continue to see that accumulation. But like at the start, I said one of the statistics which we are looking at, that currently the gold as a percentage of central bank FX reserve is around, let's say 20 odd percent. We expect it to rise towards 25, 26% over the next 4 to 5 years. And that's where I think that basically shows that the kind of accumulation that we could see in the coming years.
What about digital gold in India? How is the popularity?
See, in India, the ETF, if I consider ETF as a kind of a digital gold, yes, it has picked up pace quite a bit. If you look at the asset under management, it has increased significantly, because though India has been a very traditional physical gold country, because we love to have our gold in our hand in the form of bars or in the form of jewelry, right? But at the same time, we have seen a lot of financial investors come into the market, because there are several advantages of the financial way of investing in gold. One of the biggest advantage being the higher liquidity, and second being that you could actually hold it at a much less holding cost. So that's the reason why we have seen a lot of financial investments come into the market through the ETF route.
So if either ETFs, or what about buying gold miners? If you are expecting this continued rise in prices, would be buying gold miners also be a good way to get exposure?
Absolutely, but one has to remember that when you're trying to buy an equity of or companies who are into into gold and silver mining, they tend to be extremely volatile. So yes, so people with that kind of a risk appetite, they could look at taking exposure, because as I said, gold and silver, because along with gold, we are also quite bullish on silver. In fact, we are overweight on silver on this front. So if you are buying a gold or silver mining company and you have done your research well, then it can be a dual play.
I'm making note here that India is repatriating gold that is stored abroad. But in China, the Shanghai Gold Exchange has announced its first offshore physical gold delivery vault in Hong Kong. This as China is looking to expand its role in the bullion trade. Here in Hong Kong, John Lee, Hong Kong's chief executive, in his policy address, talked about developing Hong Kong into a gold trading center. How do you read into these types of moves by China and Hong Kong in the gold space?
China has been actually taking a lot of proactive steps in actually expanding the gold market, because it's trying various ways of ensuring that a lot more household investment flows happen into the gold market, and these are measures in that directions. We are seeing similar moves in India as well. Yes, as far as the international delivery goes, that has not happened. But if you look at how the steps the government has taken, like they had announced decade back the creation of the SGBs, which was basically the sovereign gold bonds, and as I said, the ETFs, and also there has been a lot of emphasis on ensuring there is a lot of delivery through the exchanges. For example, the MCX, which has become a kind of a reference point for the physical market in India. So, and plus the NSE is also coming up with its the gold derivatives. So there is a bigger ecosystem which is emerging along with the physical market. The financial ecosystem is also emerging to bring in the investments from the households.
I'm seeing that gold bullion fares better in a low interest rate environment. So as we continue to watch the Fed and wait on their next Fed cut, so is that, of course, also going to be a further wind in the sails of gold prices?
Yes, because, and it's not just the interest rates which will also matter for gold, because see, the whole policy uncertainty. On one hand, Mr. Trump is basically taking on the Federal Reserve chairperson. So that also creates a certain kind of an uncertainty and undermines the confidence in the US financial system on the US dollar. So that is an additional thing. And apart from the fact that the Fed actually goes ahead with the cuts from September, October onwards, that will also have a positive impact on the gold prices. So that's the reason why I said that from end of June till September end or October, the gold prices may continue to consolidate, and from October onwards, it can start taking off.
And we'll see when we get to 4,000. Anindya, thank you very much for joining us today, talking through bullion. Anindya Banerjee from Kotak Securities. Taking a look at Treasury yields, we're tracking the Wall Street Journal report that President Trump has considered naming the next Fed chair early in September or October. Powell still has another 11 months in his term. We're tracking the 10-year Treasury bond 4.273%, the 2-year at 3.7643%. Trump, of course, coming under increasing criticism and Jay Powell as well from the president, calling him terrible for not lowering rates during a NATO press conference. It came as Powell defended the Fed, staying cautious as Trump's plans were a risk to inflation. The dollar hitting fresh 3-year lows against the euro on concerns about the threat to the Fed's independence. Coming up, we will track the latest on the geopolitical front, from the NATO summit in the Netherlands to SCO defense ministers meeting in China. Stay tuned to Inside India. Welcome back to Inside India. President Donald Trump says the U.S. is planning to hold talks with Iran next week after what he called a, quote, victory for everybody in the war between Iran and Israel. Trump defended his use of bunker buster bombs on Iranian nuclear sites, insisting that the U.S. had succeeded in obliterating Iran's nuclear facilities. U.S. intel had earlier suggested the strike may have only delayed Iran's program by only months. Here's what Trump had to say about the planned upcoming talks.
We're going to talk to them next week with Iran. We may sign an agreement. I don't know. To me, I don't think it's that necessary. I mean, they had a war, they fought. Now they're going back to their world. I don't care if I have an agreement or not. The only thing we'd be asking for is what we were asking for before about we want no nuclear, but we destroyed the nuclear. In other words, it's destroyed. I said, Iran will not have nuclear. Well, we blew it up. It's blown up to kingdom come. And so I don't feel very strongly about it. If we got a document, it wouldn't be bad.
Trump making those comments from the NATO summit in The Hague, where leaders affirmed their commitment to the alliance. They also agreed to hike the defense spending budget to 5% of GDP, as demanded by President Trump. CNBC's Steve Sedgwick has this report from The Hague.
So after all the big questions that were raised about Article 5, about Spain, about US commitments, we have a summit declaration which I think answers a lot of questions. And I've spoken to a couple of key delegates here who said it was an incredibly positive meeting with Donald Trump. So let me go through it. One, there's a reaffirmed commitment to Article 5, to the transatlantic bond, an ironclad commitment to Article 5. Don't forget that that is an attack on one, is an attack on all, and will have a unified response. A lot of people were very worried about Donald Trump's commitment to Article 5. Also, absolutely pivotal point. Donald Trump, in return, wanted more spending from the Europeans. And the second bullet point in the declaration says allies are committing to invest 5% of GDP annually on core defence requirements and related spending by 2035. Now, within that, the third point says there's going to be two categories. One, 3.5% agreed on a definition of defence expenditure, and 1.5% on infrastructure, on resilience. Again, both of these areas will be reviewed by 2029. To look at the trajectory, and I just spoke to the German foreign minister who said yes, the Spanish did sign up to that as well. When it was 31 against 1, they were pretty much put in the corner where they had to go along with it, according to the various people I've been speaking to. Right, a shared commitment to expand defence industrial cooperation and harness technology as well. The next meeting will be in Turkey in 2026. But for all the fears about Donald Trump and the United States and their commitment here at this 2025 Hague summit, it appears a lot of those fears have been misfounded, and the key diplomacy from the Secretary General of NATO, Mark Rutte, and from the likes of Germany, from Britain, from France, from Finland, it looks like that diplomacy has scored a big win for the transatlantic alliance. Steve Sedgwick for CNBC in The Hague.
Meantime, another meet we're watching for is the BRICS summit early next month. The Kremlin is saying Russian President Vladimir Putin won't be flying to Brazil for the summit. Putin won't be able to travel due to an outstanding International Criminal Court arrest warrant. That's according to the Kremlin. He will instead join via video conferencing. Now, this comes after the Chinese president decided to skip two, citing a scheduling conflict. Elsewhere in China, the Shanghai Cooperation Organization, or the SCO defense ministers meeting is currently underway. India's defense minister is in attendance. We saw visuals of him arriving into China in the early hours of Wednesday. Singh called on the SCO to not hesitate in criticizing countries providing shelter to terrorists. Pakistan's Defense Minister Khawaja Asif is also present at the summit. It is the first encounter between the two defense ministers since their military conflict last month. Coming up, India or China, which market is sticking out to foreign investors amid increased volatility? We'll discuss after this short break. We'll be right back. Let's give you a quick look at Asian markets, and very mixed today with the Japanese markets. The Nikkei 225 higher by 1%, looking to be the leader on the board here, 39,360. The Kospi taking a hit. This is profit taking following that big run up after the recent presidential election of Lee Jae-myung. We got the Kospi at 3,044. The market there down 2% today. The Hang Seng Index off 0.4%, but the TAIEX managing a gain of 0.4%. As tariffs and geopolitics continue to affect consumer confidence, IKEA is going all out to get more footfall into its stores. The Swedish furniture giant is cutting menu prices at its in-store cafes, offering as much as a 50% discount at its global restaurants. And this is to help consumers dealing with rising cost of living. Meanwhile, IKEA has also been keen in trying to increase presence in India. I spoke to the chief operating officer of IKEA Retail about their business in the country.
India is yet another of these very big and important markets, and especially for a company like us where we state we want to create a better everyday life for the many people. Considering how many people lives in India, it is and will continue to be a very important market. We see that this year our business is actually improving and growing in India. And we also see that the expansion plans are creating an impact and effect. We have launched e-commerce in almost 70 cities, and we have so far in India this year been able to welcome and host up to 300 million people, both online and offline. And we see a great expansion opportunity for IKEA since we are just operating in very few places at this stage.
So in the Indian market, it is a mixture of online and offline retailing.
Yeah, like we see in other places. Today in India, 30% of our business comes from the online business and 70% from the offline, which is kind of a similar number that we actually see in many places where we operate. So India is not sticking out in any way. And we see that the more we can expand also physically, the more we are improving our online business as well, since they go very much hand in hand.
We're seeing India as wanting to be more for production and manufacturing, and the bigger plan is for sourcing materials indigenously. How much of your product there is locally sourced?
At this stage, we have 30% of our products being sold in India, produced in India, and we have an aim to get that number up to 50% as the next milestone.
You can read more about IKEA and its €2 billion bet on staying affordable on CNBC.com. We are counting down to the market open in India, and this is how we are shaping up. We're looking at Gift Nifty futures positive ever so fractionally. The Nifty set to open at 25,244, and just tracking the rupee against the greenback, 85.91 last traded. Mark Franklin is the deputy head of multi-asset solutions at Manulife Investment and Management and joins me from Singapore. A very good morning, Mark, and thanks for joining us today. I want to get your take on what we're seeing play out in the markets. Of course, everybody was glued to the situation over in the Middle East. Things seem to be, okay. The ceasefire has managed to hold. How are the markets taking the news?
Good morning, Emily. It seems to me that markets have discounted effectively an extended pause and a localization of the conflict that doesn't spread beyond the immediate theatre. There are clearly still some unanswered questions, the extent to which the nuclear question has been fully resolved, but also the extent to which Iran is reconsidering its strategic goals in the region as well. So don't rule out the possibility that that theatre reignites again at some point down the line. But for the time being, markets are somewhat sanguine about the consequences. And one of the key barometers is the oil price. And the fact that the Straits of Hormuz have remained open is critical for the global economy.
Some of the side stories coming through from the Middle East conflict is that China can still buy Iranian oil, as announced by President Trump. How closely are you watching that?
It's an acknowledgement that other parties to the conflict or stakeholders in the conflict could not necessarily be reasonably expected to remain on the sidelines completely, given the economic interests, in particular the oil flows. And President Trump is right to highlight that China sources a significant proportion of its imported energy from the Straits of Hormuz, but also the European Union does as well. And so clearly commodities and money flows really ultimately decide the outcomes of these disagreements, these conflicts. And that's why I think Trump alluded to the involvement and the economic impacts that China and other economies might have if there was any significant or sustained disruption to energy flows.
Of course, also this week is a testimony by Jay Powell. Of course, he's on the Hill and a meeting with the lawmakers there. Anything that he has said that jumps out at you, given that he says that he can take more time to look at the impact on inflation from the Trump tariffs?
Not just the testimony itself, but if we look at the last week, there are clear lines of delineation between the Fed committee members in terms of their views as to what happens next with rates. You've had a couple of speakers in the last few days emphasize that they do actually think that July should be a live meeting given the progression of the data, whereas Powell and Collins, for example, have signaled that they're more inclined to wait and see, given that they do rightly point out that there is still a significant amount of uncertainty with respect to tariffs and how they impact price formation in both the goods and the services side of the economy. That being said, though, if you strip the tariffs question out of the equation, which admittedly is a big assumption, there are clear signs of underlying disinflationary forces at work there, both in the goods and the services side. On the services side, disinflationary forces in terms of shelter, rental rate formation in the US. And on the goods side, we're seeing excess supply of products in a number of sectors find their way onto global markets. Now, how they get into the US economy is a bit of an open question. But in the absence of tariffs, there are clear evidence of disinflationary forces work. But Powell is right to highlight that tariffs introduce a significant amount of uncertainty in the equation. We do expect at Manulife the near-term momentum in inflation and pricing formation to be softening somewhat, but probably from the third quarter of this year onwards, you are likely to see some kind of impact materialise from tariffs on the overall CPI figures.
So we are going to be getting a piece of data, a key metric for that of the Fed, and that is the PCE reading. What are you looking to there, and could it change the narrative at all?
As I mentioned, near-term CPI, PCE prints should be in a moderating trend. But if you look at rate pricing, we've now got 2 full rate cuts priced into the market this year and a further 2 next year. That probably goes beyond the dot plot. So actually markets are kind of anticipating near-term softening of inflation data. The real question is what happens in the second half of this year. And there's a wide range of possible outcomes, and it depends upon the implementation of tariffs, both in terms of their breadth and the depth. And some of these questions are still unanswered because that 90-day pause is due to run out in a couple of weeks' time. So we have no doubt that the Trump administration is working very hard in the background to establish whether trade deals can be reached beyond the UK, which will enable them to effectively pause further tariff increases beyond what's already been announced.
There has been chatter in recent weeks that President Trump is looking to name his next Fed chair early. This as Jay Powell is still in his post until 2026, so this would be months in advance. How much would this undermine his authority and the independence of the Fed?
We would take a more market-oriented perspective on this. Markets don't like uncertainty. And if you look at how central bankers have increasingly communicated to the market in the last few years, not just in the US, but also the UK and the Eurozone as well, we've had a proliferation of speakers, both voting and non-voting members, talking regularly to the market outside of the blackout periods. And the issue with that is it basically shows up more dissension, a wider variety of opinions, and that can sometimes inject volatility into markets. And so we think that the initial reaction of markets to the announcement effectively of a shadow chair would be a higher uncertainty premium. And then it comes down to the extent to which the shadow chair, in effect, is saying something very different to the official committee. If they're saying something very different, then they will also be held to account in terms of their projections as price and economic data unfold. So the incentives to announce an early shadow chair are probably skewed to the downside in terms of having a positive or a negative impact.
Let's bring the discussion back to India, and we saw how shares on Wednesday were rising. What is the outlook for the Indian markets?
One of the things that's very favourable for India right now is a profound shift downwards in inflation dynamics, and that has enabled the RBI, the Reserve Bank of India, to cut rates by quite a sizable chunk a couple of weeks ago, and there's the potential for them to do more should inflation continue to trend downwards. By cutting rates, that gives them the chance to reignite the bank lending cycle, which is kind of stabilised. And if bank lending really reaccelerates, then that should also help the domestic cycle. So there are some tailwinds, definitely from an economic outlook perspective. And then from a sentiment perspective, foreign investor positioning in India is somewhat lighter than it has been for the last 6 to 12 months. By no means low, but on a relative basis, less extended. And that creates the ability and headroom for foreign investors to re-engage a bit more with Indian equities. But at the same time, the valuation starting point never really got that discounted. And if you look across the regional Asia piece, there are clearly much more discounted equity markets from a valuation perspective, which have their own favourable story. We've seen Korea really surge off the back of the election result. Maybe you see some profit taking there, but it's really unearthed a situation where heavily discounted equity markets in the region, when you combine that with some kind of catalyst, that can provide a pretty strong incentive to investors to allocate to those markets as well. So India does have some competition in terms of attention, but also allocation of capital as well.
As we are just approaching the half-year mark, where do you call the Nifty 50 by the end of this year?
We don't express explicit targets. We think that the underlying corporate earnings growth cycle is very much intact for India. And in nominal terms, that should allow for double-digit corporate earnings growth. And then it becomes a question of whether these valuation multiples are sustainable, whether there's upside or downside. In the absence of any profound disappointment from an economic perspective, a geopolitical negative catalyst, we think that valuation multiples on a relative and absolute basis are defendable for India. And so that corporate earnings growth momentum should allow for nominal further progression in terms of the local equity market.
Why are foreign investors and net sellers of the market?
As I mentioned earlier, they've had quite an interesting choice of alternative markets that have a more interesting valuation calculus, but also catalyst as well. And I mentioned earlier Korea had been significantly unloved for some time given the political uncertainty, but also historically corporate governance discounts. Now with a clearing event from a political and from an election point of view, investors' attention has come back to Korea, and it's recognised that the market is significantly discounted. Earlier part of this year, Hong Kong, China equities as well still remain at a valuation discount. We would say that that market is probably in a bit of a holding pattern now for further signs that any cyclical improvement in the economy can persist. It's a bit of a stabilisation story there. So India's really been about having to sit alongside other markets which are starting to see some positive catalysts emerge.
As we look to the Indian market, we've also been talking about the IPO activity there. We could see a listing by the stock exchange, but also HDB Financial Services and its retail books are open, and it looks like the first day ending with a 37% subscription. In terms of the IPO activity, what are you reading on that, and are you interested in it?
It's a great question. So you have to look at the kind of participants in these types of IPOs. You've got the institutional investors, and you've also got retail investors. For retail to be really enthused about participation in IPOs, there clearly needs to be a strong story, ideally a thematic one in terms of really capturing the structural growth stories that India offers. But also as well, there needs to be a background of positive anticipation and sentiment towards the equity market relative to other stores of wealth or wealth building opportunities. And there we're in a somewhat of a neutral situation with India. As I mentioned, the domestic cycle has reasons to tick up because of inflation allowing the policymakers to cut rates. And then the second question is really about if you are securing an allocation towards a domestic IPO, where are you funding that from? Are you funding that from existing holdings in the market as well? So you buy one stock and effectively you sell another? Or are you sourcing your funding from a non-equity source and then foreign investor participation as well in the secondary market? So what you're looking for is a sense that this is going to put additive net fresh money to work into the Indian stock market, or whether it's going to be some in, some out from a funding perspective as well.
Now, I'm sitting here in Hong Kong as this is the world's IPO capital of the year. So far this year, over $10 billion raised. We had some big IPOs landing in the market here. In terms of India and its IPO market, it too is amongst the world's busiest. But you know, what more needs to happen? What kind of companies to come to market for it to really take hold as an IPO fundraising destination?
One of the linkages with the IPO story is the extent to which private equity, private credit seeks to exit. And one of those exit routes is obviously IPO into public markets. Now, one of the things that we regularly observe is that private equity globally is sitting on a huge amount of dry powder, which is meaning that they're more likely to be looking for take private opportunities rather than for exit public opportunities. So one of the linkages is probably suggestive of it's unlikely to be a trigger for a significant increase in the number of IPOs coming to market from a sale via private equity. But then secondarily as well, you're really looking for a strong equity market background to create that kind of incentive for owners, founders of companies to look to realise value, realise gains by effectively selling into public ownership a partial stake. And that there, it's more of a selective story. Clearly, if you look at US equities, whilst they started the year pretty sluggishly, that is a conducive backdrop from a valuation perspective to look to float, to IPO, to raise value. And within an Asian equity market context, it's a bit more of a neutral mixed story. It depends on the specific market that we're talking about. India there, as I mentioned earlier, valuation multiples are somewhat discounted relative to peak valuations a few months ago, but they're clearly somewhat full over a longer term time horizon. So that does create attractive opportunities, particularly for conglomerates to look to realise value via spin-off routes as well.
Given that geopolitics is a big theme that runs, what sectors would you be looking at? Do you like the defence space?
We think that geopolitical volatility is really going to be a feature of the system for years to come rather than a bug. And you're right to highlight there are some thematic stories which will actually benefit from that kind of dynamic. You know, defence as a broad theme, you have to be a bit more selective. We like the technology angle of defence, so defence technology as a way to play that for a couple of reasons as well. You know, recent conflicts have given us the observation that warfare is being conducted in a very different way now compared to even 10 years ago. The application of technology, of AI, of digital solutions has become much more prevalent. And the second reason why defence technology is an interesting way to play this as well is that a lot of technology that you find in the commercial space, in the civilian space, has started off in the defence sector. And so the total addressable market of these technological applications that start off in a military sense becomes huge if there's a crossover into the civilian or the commercial space. So we see total addressable market compound growth potential from the technological applications in the defence sector as being really attractive.
As we look at technology, I want you to compare the Indian and the Chinese markets. Who's doing it better?
It's not really an apples for apples comparison. If you look at the constituents of the public equities technology space in India versus China, very, very different business models. So if you take China, you've got, for example, the e-commerce businesses, whether it's Tencent, Alibaba. You've also got, for example, the AI proxies as well. In India, it's a lot about e-commerce and logistics. So different business models, so hard to compare like for like.
Before we let you go, leave us with an investment idea in the Indian market.
We think that you've got to align yourself with the secular growth stories that we observe in India, but also where there's a bit of a cyclical catalyst as well. As I mentioned earlier, with the RBI now in cutting rate mode, that should provide some kind of tailwind for bank loan growth to pick up both from a demand and supply perspective. So we actually think that the high quality domestic banks should have reason to perform quite well because of an earnings growth momentum story.
So India is also easing loan norms. Which sectors are going to be benefiting from that?
We think that infrastructure investment has been a long-standing story in India, particularly in Prime Minister Modi's first terms. There was a real push from a policy perspective to reignite the infrastructure cycle. That's somewhat stabilised as the mandate has been diluted somewhat, but from a private sector as well as a public sector perspective, there's clearly a huge deficit of infrastructure supply to meet that demand. So we think that infrastructure will be a huge source of credit demand, not just in the near term, but for many, many years to come.
Mark, thank you for making the time to speak to us today on Inside India. Mark Franklin from Manulife Investment Management. Indian markets have joined the trading day. We will look at some of the big movers in Mumbai after this short break. We'll be right back. Checking in on Asian markets, and it is very mixed on this Thursday day of trade. As we look at the Nifty 50, just getting started, higher by 0.3%, 25,331. The Nikkei is one to point out, higher by 1.3%. The Nikkei average touching its highest since February, as we see, of course, the ceasefire in Israel-Iran continuing to hold, albeit it is fragile. Kospi is looking at some downside off 1.6% to 3,057, and it is some profit taking following a nice run up that followed after the recent presidential elections in the country. The new president Lee Jae-myung has a Kospi target of 5,000. The TAIEX better for 0.1%, 22,461. The Hang Seng Index tipped lower 0.5%, coming off a 3-month high at 24,361. In Shanghai, better for 0.1% at 34.59. We are watching the Indian markets coming online with the Nifty 50 and traded like this. We're looking at the market at 25,333. That is a better for 0.3%. The Indian rupee against the US dollar at 85.87. Let's look at some of the movers in the Indian markets today. We're watching shares of Adani Total Gas and Reliance Industries. Reliance at 1,469, up 0.1%. Adani Total at 639 and change, higher by 0.8%. This as the Reliance Industries arm, GOBP and Adani Total Gas have partnered to sell transportation fuel across India. The partnership will involve them selling each other's fuel in select outlets. India's JSW Steel is knocking on the door of India's top court. The steel giant seeking a review of its rejected $2.3 billion bid to acquire Bhushan Power and Steel 4 years after the takeover was completed. The court also ordered a liquidation of Bhushan Power before halting it to see JSW's review petition. Shares of Vodafone Idea. We're looking at the telco, and it's 719. This as the telco in talks with India's largest public bank, the State Bank of India, to raise close to $3 billion in loans. Vodafone Idea is looking to use these funds to strengthen its network and better compete with rivals. This comes after the company's petition for a debt waiver rejected by the Indian government. It owes over $5 billion to the government. And before we end the show, an Indian national jet setting off to space after 41 years and headed for the International Space Station. That's for the first time. Shubhanshu Shukla of the Indian Air Force is in the pilot seat of the Crew Dragon heading to the ISS. This joint space mission between SpaceX and Texas-based Axiom Space is led by NASA retiree turned private astronaut Peggy Whitson. The crew will spend 14 days aboard the orbiting space lab. The AX-4 mission hopes to advance plans to build the world's first commercial space station. And that's all the time we have today on Inside India. Keep watching CNBC. Access Middle East is coming up next.